This is the Value Investor Podcast with Tracey Reineck. All things value, all the time.
Welcome back, value investors. So I have an important question this week to ask. How long should you own a stock? This is kind of a big deal for value investors because we tend to buy and hold for a considerable time period. Warren Buffett has often said the time to sell is never. So his whole philosophy, but even Ben Graham's, has been, you're buying for a long time. And he mostly has stuck by that kind of philosophy with many of his stocks. He's owned some for 20, 30 years even. But recently, he's been selling quite a bit out of the portfolio. I don't think it's him. I think it's the lieutenants. But either way, the Berkshire Hathaway portfolio has seen more turnover. So, for instance, we know he's been selling some of his Chevron position, or maybe it was the original Chevron position, and then he bought the big chunk. And now some of that has been sold off. I don't know, but some of that has been sold off. And some of the Chevron position was like bought one quarter, sold the next. We know Taiwan Semi, he bought and then sold the next quarter. That was weird. And then he's bought some of the home builders, including D.R. Horton, and he's sold off of all the D.R. Horton. I think he only owned it 3 quarters, perhaps two or 3 quarters. That seems bizarre. But a bigger question is really, how long should you own a stock? There are always good reasons to get out of stocks, and he would give some good reasons. I know he's talked about it just not being the correct thing with Taiwan Semi. Recently, he sold a decent chunk of Apple out of the Berkshire Hathaway portfolio so that it's now only about 40% of the equity portfolio instead of over 50%. It was like a $20 billion sale. And he said that was for tax purposes. But another reason you might want to sell is, one, for tax purposes, perhaps, but also to diversify your portfolio. The Berkshire Hathaway, they have sold smaller chunks of Apple throughout the years because it was over 50% in the portfolio and was starting to dominate the portfolio. So you might want to sell to diversify. And we see that with some of the big founders of the big tech companies. They have 10b5-4 or -1 sales going on, and that's where they sell a certain percentage of their stock every quarter, just to lower the amount that they have exposure to in their own portfolio, to diversify into other things, because it is a little risky to keep, one huge position, even if it's Apple, to have it be 50% or more of an equity portfolio. Just that one position does put a lot of risk on just that one company. So diversification is another good reason. But also, I feel like value investors who tend to be these long-term investors also lose track of the story a lot of times. The longer you own it, the more complacent you might get, especially if you bought at a much lower price point many years ago. So maybe you bought a stock at $20, it's now trading at $100, but you bought 15 years ago. So you think, oh, I'm up big on that. But it's been 15 years and maybe you're not even outperforming the S&P 500. So that's why I always encourage value investors in particular to go keep up with what's happening with their companies and to go back and make sure things are going the way you want them to with the company. So remember when Warren Buffett bought IBM? We've talked about this many times on the show. He then sold it for a loss of several $1 billion numerous years later and said it wasn't doing what he thought it would do, the company and even the shares. So he had to change course, and he just decided to get out of it altogether and move on to something else. And that something else was Apple. But it's easy for us long-term investors to get kind of sucked into the complacency of a big name stock like an Apple and or an IBM even, and not really pay much attention to what is actually going on with it when you own it 10, 15, 20 years. So these are always good questions to ask the longer you're in a company, because a lot can change with its business model. Obviously, the management is likely going to change. And, especially if it's technology, things move quick in tech. And so maybe the company isn't doing anymore what you had hoped it would do. So I was taking a look at Apple, and over the last 5 years, the shares are up 326% versus 67% for the S&P 500. So it has been a big outperformer during that time period versus the NASDAQ. The NASDAQ is up 119%, so much better than S&P at 87, but still well under what Apple is doing. So I know many of you bought it 5 years ago, perhaps, and you're like, oh yeah, I'm doing real good. So I have no problems just kind of holding on to it. But when you look at a 2-year stack for Apple, that's when the story begins to change a bit. So Apple's up 38% on the 2-year stack. That's still beating the S&P 500, but just barely, because the S&P 500 is up 35% during that time period. And the NASDAQ, however, is up 47%. So the NASDAQ is now outperforming Apple on the 2-year stack. Now, in the grand scheme of things, if you're a long-term investor, 2 years is nothing. That's a very short time period, really, in the longer scheme of things. So I'm not saying, anybody in Apple should be panicking, over this slight underperformance, really, over the last 2 years. But it is something that investors, long-term investors, should be keeping an eye on for, what's going on at the company. Is it still performing in the way you expect and want it to perform? And just because you've owned a stock for 5 or 10 or even 15 years doesn't mean you shouldn't be getting out of it, right? Again, I think people are always kind of surprised at what's going on with the stock that they've owned for a really long time, because it can you normally do have some big gains in it, hopefully, and it seems like, oh, everything is fine. So another stock that I own in my own personal portfolio that I have owned for 10 years is StarBucks, ticker SBUX. And it just recently had a big share sell-off, but the stock has been struggling a bit even before that. And it sold off because the same-store sales in the U.S. weren't as good as everybody thought they would be. And the customer is not handling the price increases on the product all that well, and they are pushing back. So people freaked. The street was a little worried, and they sold that stock off. But you could say, oh, but it's Starbucks. Over the longer time period, it's not doing too bad. But that's not really the case with Starbucks. And this is where the complacency really sets in if you've owned something for a long time and it's one of these big name type of stocks. So over the last 5 years, Starbucks now is trading up, but just 2.2% over the 5 years. And again, the S&P 500 is up 87%, and the NASDAQ's up 119%. So that's not just a little underperforming there. That is some major underperforming over that 5-year time period. And it doesn't really stop there. It has not been that great even over the longer time period, because Warren Buffett would probably say even 5 years isn't really enough time period to really know, what is going on with a company and to really see the patterns there. Yeah, even 10 years isn't really probably long enough. But it seems really long for many of us, right? Most people not used to owning for 10 years a single stock. So just taking a look at the 10-year track record, and it's still underperforming over the 10 years. So it's up, but it's up 119% versus 182% on the S&P 500 and 298% on the NASDAQ. So it's not even close with the NASDAQ. All you had to do was buy one of the major indexes and you would be doing better of the big cap indexes, of which Starbucks is in the NASDAQ. So even with that one, I put in the triple Qs just out of curiosity too. I could have just bought that 5 years ago or 10 years ago, and that's up 417%. So 417 versus 119 for Starbucks. And that's not, Starbucks isn't alone in kind of this underperformance. I'm thinking of Walt Disney. A lot of people own that because they buy it when they have kids thinking this will be a good investment. I know people have done that and maybe they bought, 10 years ago or 15 or 20 years ago. So over the last 10 years, let's just look at that as a comparison with Starbucks. We know the stock has struggled in recent years, like during the pandemic and right now here in 2024, but it's up 52% in the 10-year stack. And this is like, for some reason, Yahoo is giving me April to April. But that's still 10 years, 52%. And we have the triple Qs again. This is from April 1st to April 1st is showing me 384%. And the NASDAQ 272 and the S&P 168. So again, if you're thinking, I'm buying this to do for my kids, to pay for their college, that hasn't really worked out well. I'm looking back even another 10 years to 2004. So April to April 2004 to 2024. Maybe your kid is in college now. You bought in 2004 and they're 20. And it's up 350%. The S&P 500 is right around there. So S&P might be slightly above. So you're basically in line with the S&P 500. That's not terrible for that amount of time because you probably would have bought the S&P 500, right? The NASDAQ's up 738, but the QQQ ETF is up 1,165%. So about triple the S&P 500. But most of us probably would buy the S&P, so it's kind of in line. But that might be shocking to a lot of you, right? To find out that Disney, a stock you thought was doing well for much of that time, really isn't doing all that well. And this is true of a lot of these kind of big name stocks, things you thought were doing really good, and that you've kind of held on. But not all of them. We know a lot of the tech names, the Mag 7s, have recovered from their sell-off from 20 years ago, and those are outperforming. I just took a look at McDonald's, and it's up big in the 20 years. It's up 886%, and really started having like a big run about 10 years ago. So that's been a good one. But it's a crapshoot, right? Some of these you think, oh, this should be doing well, and it isn't. And now I know many of you are wondering, like, should I get out of some of these stocks that are really, really struggling over the last couple of years? And again, the advice that Buffett would give is, even what he did with IBM, is it doing not the stock, but is the company doing what you thought it would do? And I've been asking myself that with Starbucks. Like I said, I've owned it for 10 years, still love the product, but I'm wondering if management is taking it in the right direction now as well. So I'm keeping it on my watch list for right now. But something you could do if you're wondering whether or not you should get out of a long-term holding, a stock you've owned for a long time, is to sell part of it. Nobody says you have to exit the entire position. You can redeploy some of the money somewhere else, or you could, as obviously, just bite the bullet and get out of that position, deploy into an index or something else you feel more positively about and you think is going to be growing those earnings and sales in future years. So it's not easy to hold on to a stock for even 5 years, but certainly not 10 or 20 years. There's a lot of up and downs in there, as we've been seeing, even just from 2022. Think about all the stocks that sold off big in 2022. Then we have the other question of you did have a big gain in the stock, and then it's had like the massive sell-off. And I'm thinking of like a Shopify, a Block. Some of these look cheap. And as value investors, maybe we're in there and we're dollar cost averaging to get, a better attractive entry price now that it's sold off. But it all comes back down to, is this what you want from management? Is this the place for you to be? And the answer may surprise you when you actually start asking it, because I know it has for me. So Starbucks, by the way, it did have that big sell-off. It has actually been rallying a bit off of the big sell-off, but still not that cheap on a PE basis, at least. It's trading at 21 times. So it's not as if you're getting it super dirt cheap. Same thing with something like a Shopify. So Shopify is up just 112% now over the 5-year stack. And this was a stock that was soaring during the pandemic. So I know many of you were probably in it. And if you're a value investor, you were holding it on the way down because fundamentals were still staying pretty good during that time period. And now they have been on the upswing and they appear to be improving again. And so the question is, should you continue to hold on to these stocks that are, struggling for multiple years now? And Shopify, it's not very cheap on a PE basis. It's still trading at 59 times. The other interesting thing is that when a growth stock becomes more of a value is usually when the market abandons it, right? Apple's not really much of a value yet because the market really hasn't abandoned it. But when it does, it will get much cheaper and you will be wondering, why isn't anyone buying this? And I've said that with a stock like Block, which is ticker SQ, because those earnings are moving higher. They are on the move and they look pretty good, but the stock continues to just kind of lag and not really go anywhere. It's trading at 22 times, but it has a PEG ratio of 0.7. And that's really low. So it has both value and growth because earnings expected to be up 73% this year and 30% next year. But the street doesn't really care. That's a classic value stock when the street is like, meh, I'm not really into this. Another stock that you might want to start asking some questions if you're a long-term holder is Tesla, ticker TSLA. Is that getting cheap as the shares are pretty weak here? It has a PE of 75 now, and that's because the earnings are being mostly cut and have come down. So they made 312 last year, expecting to make 247 this year, a decline of 20%. But next year, the analysts are a little more optimistic, but some of those estimates have been cut as well. So they're now looking for 324 for next year. So that's a gain of 31%. But they were looking for 416 just 90 days ago. So those have come down pretty sharply, and the analysts are pretty pessimistic. Now, if you're a long-term investor, 1 year of declining earnings isn't going to make or break you. Every company goes through some rough patches, and maybe the economy goes into a recession, and we get those earnings also going into a recession where they decline. So you may not have rising earnings every year for most companies, and likely you won't. But it's a matter of, when is the turnaround? What does the turnaround look like? And maybe the shares do get cheap enough to dollar cost average into your position, and add to it when it gets a lot cheaper. But with the earnings coming down quite considerably here on Tesla, it still has that really high PE, and it's got a PEG of 3.5. Now, I know most of the long-term owners of Tesla don't care about any of the stats, really. And they did care when it became profitable, which it finally did. But they don't really care about paying a lot for the stock because they're buying it as a tech company, or, maybe for the self-driving technology, or even the superchargers now. Maybe they're buying it for that. They're not buying it just because it's an auto manufacturer. So there is other reasons why long-term Tesla shareholders are, hanging on and being in there. Their patience has also been rewarded, right? But this is the issue that I was addressing with the really long shareholders, is that sometimes you do grow complacent, right? Maybe you're not noticing changes in the company, either with management or just with the business model. And you think, oh, this is just like, 5 years ago when they hit a rough patch, and not that this is a rough patch that could go even longer. So, Tesla is an interesting case. There is kind of like just this group of early Tesla shareholders who bought in, were big beneficiaries. Some became, millionaires even off of Tesla, from buying in the very early innings and being like a Tesla bull. But things are looking a little different if you have bought in the last couple of years. So over the last 10 years, from April to April, the shares are still up 1,218%, right? So if you did buy somewhere way back in the day, you're still up big. So, you're not worried at all about what's going on with the stock. But that's where the complacency really takes over for many of us value investors, is that, it looks good in that long period. Now, I'm also looking at the 5-year period, and it's still up 1,300% in that 5-year period, because it really did soar in 2020 and 2021 before coming back down. So it's still a great outperformer, even if you bought it only 5 years ago. It's mostly, in the last year where it's really taken a bigger hit, and it's down 0.9% in the last year. The S&P 500 is up 26%, and the QQQs are up 34% in the last year. So you're only underperforming those really in just this last year. Let me look real quick at the 2-year time period. You are also underperforming in the 2 years. So I guess it goes back more than just the year. It is in the 2 year, because it's down 19% in the 2-year stack, and the S&P is up 35 in that time period. But that's all more recent news. Long-term shareholders are supposed to be long-term. So it's something to keep on your watch. If you are a long-term Tesla shareholder, watch what's happening with earnings. If those turn around, like I said, a lot of these companies have rough patches. I've seen my own with StarBucks over the years. And, every company is going to encounter that It's just a question of what is going on behind the scenes, and does it look like it's temporary and not permanent? Those are the hard questions to answer, right? So how long have you owned a stock? Are you keeping track of what's going on with it? It's okay to sell out of a long-term holding. It doesn't always work, or maybe you just want to cash in on some of your profit eventually if something else is kind of going on behind the scenes that you don't like. Nothing wrong with actually getting out after being a long-term shareholder, or just lightening your position, as Warren Buffett did with Apple. He got rid of a big chunk, but he still has a 40% position in his equity portfolio. That is still enormous, and it's still going to pay him a big dividend every quarter as well. So you can follow the Buffett method of getting rid of just like these slight positions on some of these when you've owned them for, multi-years or longer. So let me recap some of the stocks we kind of just chatted about. These aren't like, oh, you should rush out and buy these right now or anything, but just some that I mentioned. There is, of course, Apple, AAPL is the ticker for that one. Starbucks is SBUX. I haven't done anything to my Starbucks position since that sell-off. And again, it has recovered a little bit, but I'm being patient because I do still like the company, and I'm sticking around in it for now. Shopify, talked about that one. SHOP, Disney. That's a bigger question. I know many of you own it and have for a long time, but if you're still in it, there are some bigger difficult questions there, and that's DIS. And then I mentioned Block a couple times because I am still surprised at where it's trading at given those earnings, but that's a value stock type of thing. And many of you might have owned that for the last 5 years too, right? Because it was big during the pandemic. Everybody was buying stuff online, and those small transactions, and a lot of people signing up for Block services during the pandemic. Over the last 2 years, the shares are now down 19%. So it's around where Tesla is over the 2-year time period. And 5 years, it's up only 3.9%. S&P at 87%, QQQ's at 154. And that's pretty shocking because during the pandemic, it was up as much as 300% at that point. And now it's plunged down. So yeah, I guess I'm really liking Block these days. Tesla's the other one, TSLA. It is not cheap on a PE basis, but the shares have, pulled back considerably over the last 2 years. But I know many of you have your reasons for being in it over the long haul, and it has paid off for you if you're a 5-year or 10-year shareholder of Tesla. So these are all the questions you should be asking out there. It's not an easy question to ask, and it's not easy to know what to do when you have owned a stock for a long time. Should you just keep owning it? Should you sell it? Should you add to it? Dollar cost average. These are all tough questions, but we try to answer them here on the Value Investor Podcast because us value investors are long-term investors, and we don't always get it right. Buffett has admitted some of his trades that he's gotten wrong in the past, both buying and selling. And so even the greatest investors don't get everything right. We won't too, but it's good to always take a look at your portfolio, know what's happening at the companies you own, especially the ones you've owned for all those years, because there's no guarantees that any of these companies will be in their same form even 5 or 10 years from now. So be sure to subscribe to get all the Value Investor podcasts. I have them every week. So we're bringing you as many value stocks as we can, and just topics that are of interest to us value investors like this, like how long should you own a stock? And so be sure to get us on Apple. We're on Spotify. We are on Amazon Music. You can get us on YouTube, but put in Zach's podcasts and you'll get our other podcasts, which are worth listening to as well, including ETF investors. And we have earnings, and just even the global outlook is over there as well. So be sure to get us somewhere, and I'll see you again next week with some more value stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.